Welcome to today's webinar, hosted by AVCs, entitled The Local Government Pension Scheme and Shared Cost AVCs. My name, as you'll see on screen, is Tim McEwen. I have spent over 15 years working with the Local Government Pension Scheme and AVCs. Most of that time was spent with Prudential, who many of you on today's webinar will know are an AVC provider for the majority of local authorities, the length and breadth of the country. Now, at Prudential, I have helped thousands of members just like yourselves retire early and or retire with more money. At AVCwise, we help employers like yours offer what's known as salary sacrifice shared cost AVCs. Snappily titled, I know, and we'll refer to them as shared cost AVCs for the rest of today. Just a note about today's webinar, it's factual information only. It does not constitute financial advice. It is based on our current understanding of taxation, legislation, and of course your scheme rules. You should consider your own circumstances after today, and if you're in any doubt, we would always encourage you to speak to a financial advisor for individual advice. What we're going to cover then today, we're going to have an overview of the local government pension scheme. I'll introduce you to an employee benefit called shared cost AVCs, and how those shared cost AVCs can be taken in retirement. More specifically then today, we will cover the local government pension scheme and the three calculations that make it up. I'll introduce you to Sarah. She's our case study for today, retiring at her normal pension age of 67. We look at ways in which Sarah can increase her benefits, including the unique opportunity that is shared cost, AVCs. We look at how they work, when and how you can take them back. We'll talk about tax-free lump sums quite a lot, and ultimately I'll show you how you can make it happen or how you can apply. The scheme, first of all, then. So an overview of the local government pension scheme. Let me start by saying that the LGPS is one of the best pension schemes in the UK. It has a significant list of benefits, and I'll go through some of those with you now. First things first, it gives you an element of security, because you know that your pension benefits are based on two things. They are based on your service and on your salary. That will give you a guaranteed income that is payable in retirement. It is paid every month, paid for the rest of your life until you die, so it won't run out. Importantly, it's index linked, that the pension increases in line with Consumer Price Index, which you will have heard of, CPI. That will help counter the effect of inflation. And just a point to note there, in the last 10 years, we have seen local government pension schemes go up by about 20%. And so very important. If you were in the scheme before 2008, you would automatically have been building up a tax-free lump sum in addition to that pension. Now, of course, to maintain the value of this fantastic pension scheme, someone has to pay for it. You do, and indeed your employer does. Now, of course, we have different employers are represented on the call today. So on average in the UK, employer contributions are about 19%. You as a member also pay. On average, member contributions are probably about 6 or 6.5% maybe. But that is dependent on, of course, your salary. Okay. However, you do get tax relief on the contributions. So it's a very tax efficient way of saving, paying into pensions. We'll hear a lot about that later on. If you fall in hard times, you don't have to necessarily come out of the scheme altogether. You have what's known as a 50-50 option, where you, as the name suggests, you contribute 50% less, but of course your benefits, you're only getting half of those benefits. In retirement then, you do have what's known as flexible retirement. You'll have maybe seen colleagues who have done this, where you have the option of reducing your hours and or pay on one hand, but also having access to your pension. best of both worlds, really. You can work part-time, still be in the pension scheme, but also be drawing on some or all of that pension. What happens if you don't make it? It doesn't die with you. You have, of course, what's known as death in service. That is a tax-free lump sum that is paid at date of death, should you not make it to retirement. This goes to your nominated beneficiaries, subject to pension fund approval. In addition to that, if you die in retirement, you have what's known as a survivor's pension. Up to 50% of your pension would be payable to a spouse, civil partner, or eligible cohabiting partner, or indeed even to eligible children in certain conditions. And as you can see on screen, ill health retirement. This could be payable at any age if you cannot work due to ill health without reductions. There is a requirement that you would have 2 years service for ill health protection, and of course you would be subject to medical certification. Okay, and I'll show you more later on where you can get more information on the scheme itself. Now we're going to have a look at how the scheme is actually calculated. Okay, so from the 1st of April 2014, everyone on the call today is in what's known as a Career Average Revalued Earnings Scheme, or CARE for short. How that works is that for every year you work, a 49th of your salary is effectively banked in your pension pot. And that will happen next year and the year after, and so on and so forth, until you reach retirement. In addition to that, as the name suggests, it's revalued using, again, CPI, in the hope that the amount banked each year is also going up. And that, when all totted together, will give you an annual pension in retirement. And I'll show you an example on the next slide of how it all works in pounds and pence. Okay, if you were in the scheme before 2014, from 2008, 1st of April, to 2014, you were in a final salary pension scheme. How that worked was that for every year you worked, you got a 60th of your final salary as a pension in retirement. So some of you on the webinar today will have the maximum of 6 years service. That's 6/60 of your final salary as a pension in retirement. Before 2008 then, if anyone on the webinar today was before 2008, you were in a final salary pension scheme, but it was calculated slightly differently. It was on an 80th basis. So for every year you worked up to 2008, you got an 80th of final salary as a pension in retirement. Okay, now the mathematicians will tell me, of course, that that's not such a good fraction, if you like. But in addition to that 80th pension, if you were in the scheme before 2008, you were building up an automatic tax-free lump sum. And the tax-free lump sum was 3 times whatever your pension was in that part of the scheme. To bring that to life for you then, we'll look at Sarah. Sarah, we're going to make a few assumptions. We'll assume that her salary was 25,000 when she joined the care scheme. We'll assume that she gets a 1% pay increase each year. And at retirement, at 67, her final salary is 29,608. One other assumption that we're going to make about Sarah is that she joined the scheme in 2007. So therefore has 1 year in the 80th scheme. That gives her a pension. And of course, 3 times that pension as a lump sum. We're going to assume that Sarah was full-time, so she spends 6 years in the 60th scheme. If you are part-time, by the way, just on that point, it is the year's service that is affected. The final salary is still the full-time equivalent salary. So if you're working 50% of the week, you would have 3 years service in that scheme. Sarah's full-time, so she has 6 years, 6/60, more pension, no lump sum. We're then going to assume that Sarah spends 18 years in the 49th scheme. Now remember, that's 18 different calculations, but ultimately it gives her more pension. When we tot that all together, for 25 years' work, Sarah has built up a pension of just under 15,000, 14,900. That's about half of what her final salary was. And of course, she gets her 1,100 lump sum. Now, I'll imagine that a lot of you are maybe looking at that slide thinking, oh, hold on a minute, I don't really want to work to I'm 67. Jonathan and I are no different. Sarah's no different. So what we're going to look at in the next slide is Sarah retiring early. Sarah wants to go just 3 years early at the age of 64. Now, the first thing to note is, of course, she will have 3 less years in the scheme. So 3 less 49ths, if you like. And so that is, of course, going to impact the amount she gets back. However, in addition to that, we refer to it as the double whammy of early retirement. In addition to the less 49ths, the pension scheme will also reduce the amount that Sarah gets because she is getting it early. Because you're effectively getting paid your pension from 64. The effect that will have on Sarah's pension is quite significant. You can all draw breath and take in that figure, £4,000 a year, quite significant. And that, remember, is for the rest of her life. Okay, so in reality, can Sarah afford to go early? Can you all afford to go early? The good news is you've probably time on your side to do something about it. Okay, so now that I've depressed you all, I'll try to lighten the mood somewhat and lift the tone, because we're going to look at ways in which you can improve your benefits and maybe how you can get out early. Within your pension scheme, there are a number of different ways in which you can improve your benefits. The first one of which is known as additional pension contributions, or APCs. And these allow you to buy extra guaranteed income or pension that's payable for the rest of your life. It is essentially a contract between you and your pension scheme. You agree to pay a fixed amount of money for a fixed period of time. One of the advantages of it is that you know at the start what you're going to get back if you complete that contract. It's a fixed amount of pension. Now, as I mentioned earlier, of course, pension index-linked pension doesn't necessarily come cheap. You're paying upwards of 6%, your employer's paying 19%. So for that reason, when you go to pay APCs, they don't come cheap. The take-up rate of them is quite low. And you should also I will also point out on that, there's no spouse's pension with APCs. It will die with you. You may also need to complete a medical before taking one out. You do, however, get tax relief. Mentioned that earlier. You get tax relief when you're paying into pensions. The APCs do go up in line with inflation. However, they are not flexible. You can't stop and start them. If you stop and want to restart, well, then it's a new contract. There is a calculator tool for APC purchases on the Local Government Pension Scheme website, which I'll direct you to later. You can get yourself a quote. It'll take about 2 minutes. And I don't apologise for making this sound quite blunt, but if you get yourself a quote, you can effectively work out how long you have to live for in retirement to get your money back. In reality, far more people will be paying AVCs instead of APCs based on cost and flexibility. More on AVCs shortly. Before we get to that, however, I want to take you back a few years. I'm going to take you back to when the government introduced their pension reforms. These pension reforms, on one hand, were designed to simplify and standardise things, but on the other hand, it was to encourage us to save, because generally speaking, we don't save enough for retirement. We're living longer. The encouragement to save more, part of that encouragement was that we'd be allowed to take out more as a tax-free lump sum. Whichever pension scheme you belong to, of course, you're all members of LGPS, you're now allowed to take up to 25% of the benefits out as a tax-free lump sum. And that's much greater than it was under the old rules. So think about Sarah. She was getting 1,100. Whatever lump sum she's getting, whatever lump sum you're getting, some of you might have more years in that 80th scheme, of course, but it will come nowhere near the maximum that you're allowed. So how do you go about getting it? The first thing that you can choose to do is nothing. You can do nothing between now and when you retire. And when you get to retirement, the pension fund will allow you to give up your pension in exchange for a bigger lump sum. You can exchange your pension at a rate of 1 to 12. It's known as a commutation rate. So let's think about that for a minute. Let's assume you're like Sarah, many of you will be, you want to retire before 67. If you want to go early. And in addition to that, many of us are living to our mid-80s in retirement. So if we think about this, if we give up £1,000 of pension, you'll get £12,000 of tax-free cash. Right. What you've given up, however, is £1,000 of pension this year, next year, and of course for the rest of your life. That also would have been going up in line with inflation. I did mention that earlier. Pensioners in the scheme have seen the pension go up by 20% in the last 10 years. Never mind 20 years in retirement potentially. Now, of course, this would be a very easy decision to make if you know when you're going to die, assuming you maybe don't know that. But joking aside, if you were in really poor health when you got to retirement, it might be an easy decision, to say, I'll have the bigger lump sum. I'll not be around that long to take my pension, so I'll do this exchange. However, wouldn't it be lovely to be able to have both? Get a bigger tax-free lump sum, but without having to compromise the pension to do so. That, folks, is where AVCs come in. The unique opportunity that you have within your scheme. If I could sum AVCs up for you, as I say, Jonathan and I have been doing this for 35 years between us, so if we could sum up AVCs in a sentence and save you the next 20 minutes of your life, I would simply say it is a flexible, tax-efficient way of saving for retirement. In its simplest form, it's just a pot of money. Importantly, though, at retirement, you can take all of that pot back as a tax-free lump sum and spend it on whatever you like. And remember, not having to give up any of your pension to do so. You are the only public sector scheme to allow its members to take the whole AVC as a tax-free lump sum. If I think of other public sectors, teachers, NHS, police service, fire service, cannot do this. Okay, it's only in LGPS. Two caveats to that I will add, however. If you want your AVC as a tax-free lump sum, it means having to take it at the same time as your main scheme benefits. I'll show you examples of that later. And there is always that limit that I mentioned for the tax-free cash, the 25% figure. I'll show you again how you can have that calculated later on. But as an example, Sarah, with her 25-year service, with her £1,100 lump sum, she could have built up an AVC of upwards of £71,000 and still been able to take it all back tax-free when she retires. So more on that a little bit later on. You don't have to take the AVC as a tax-free lump sum, by the way. You do have flexibility. You can buy a pension with it from a pension company or even from LGPS themselves. But you should remember that pension is taxable in retirement. The lump sum could be tax-free. Okay, now some of you are probably thinking, well, I know another way in which I can save tax-free, and it's nice and flexible, and that is maybe paying into an ISA. The difference, of course, we're talking about pensions. So when you're paying into a pension, as I mentioned earlier, you get tax relief on your contributions. You do not get tax relief on an ISA. I'll bring that to life for you in a minute or two. The second unique thing that your employers have set up is this local government AVC on a shared cost basis via salary sacrifice. What does that mean? Well, in simple terms, it means that you not only save from tax, but you also save on national insurance. And saving national insurance on AVCs is also unique to local government. Okay, now I can hear some of your questions coming in. We're going to get to those in a couple of slides' time. But before we do, let's look at a quick example. If you're a basic rate taxpayer, paying tax at 20% and national insurance at 12%, if you wanted to save £100 into an AVC, With the tax and national insurance benefits, it's only costing you £68.12. And that's an automatic uplift in your money of 46.8%. Now, if you think you can get 46.8% anywhere else, I'd certainly like to hear about it. But supposing the bank, the building society, the credit union, if they had a poster in their window that said 46.8% return on it, I would suggest you'd all be probably queuing down the street to take advantage of that. That is what you have already through this AVC. Your employer has set it up for you, giving you the ability to save money by saving tax and national insurance, which I think is fantastic news for all of you. Okay, so we're going to look at a pay slip here just to see how it works in practice, and then I'm going to invite Jonathan in. I'll take breath and maybe a glass of water, and we'll answer your questions. So, Joe, he earns £30,000. He is a basic rate taxpayer, therefore. He earns £2,500 a month. Joe pays his standard local government pension. You can see there 162.50. He also pays tax at 20% and national insurance at 12%. That leaves Joe with take-home pay or net pay of £1,875. Now we're going to assume that Joe sets up an AVC. So he works for an employer like all of you who has set the AVC up on a shared cost basis via salary sacrifice. What does that mean? Let's get to grips with it. A shared cost AVC is where both you as the employee and your employer both contribute. You're sharing the cost. Your share, like Joe's, as you can see on screen, is always £1, with the balance being treated as the employer contribution. So in this example, Joe pays his £1, his employer is paying £249. Now, before you all get excited and ask me how you get £249 off your employer, they are not going to pay it out of the goodness of their heart, of course. What they will ask you to do is reduce your salary or sacrifice your salary by the equivalent amount. So you can see that Joe's gross pay has come down to 2251. Most common question that Jonathan and I will get asked at this point is, of course, well, hold on, Tim, if I'm reducing my gross pay, is that not going to affect my local government pension? And the simple answer, folks, is no. Your main scheme is not affected by paying this because it is your what's known as notional salary, which is pre-sacrifice salary, that is used to calculate your pension. And of course, you will note that Joe's local government pension scheme contribution has not changed. What has changed for Joe, however, is his tax paid, because that has come down by £50. In addition to that, the national insurance has been reduced by just under £30. And that is because national insurance is calculated on the post-sacrifice salary. So he's paying less national insurance as well. And that has the impact of reducing Joe's take-home pay to £1,705. Now, another common question just before I bring Jonathan in is, well, again, Tim, that doesn't sound great. If I'm paying less national insurance, is that not going to have a knock-on effect to my state pension, for instance? Okay. Most employers will not permit you to pay so much into AVCs that you would fall below what's known as the lower earnings limit. That's currently £6,240. And it's only if you paid that much in that you could potentially damage your state pension. But as I say, most employers won't even allow you to do that, even if you wanted to. Just a final point on this slide. If you are a higher rate taxpayer, if any of you are higher rate, you do get tax relief at 40%. So the deal is even better. And you save national insurance at 2%. Okay, so just to bring that to life again, Joe's £250 contribution going into his AVC has only cost him £170.12. And that's thanks to, first of all, his employer, but also then the income tax and the national insurance savings. Okay, I'm going to leave that slide on screen because that's very powerful. I'll invite Jonathan in to see what questions we've had so far.
Hi, Tim. Yes, we've had 3 questions. So first one is from Darren, and Darren's asked, can you take the AVC if you flexibly retire, or is it full retirement only? Now, that's a really good question, Darren,
Really good, yeah.
because this is where people can play it wrong. And I'll give you an example of that. We had a member at a council who was taking flexible retirement, so in other words, taking all or some of their local government pension scheme, so taking those benefits and then coming back to work effectively as a new member again of the LGPS on a part-time, reduced hours and or grade. What they didn't do, though, is take their shared cost AVC at the point that they flexibly retired. So whenever you cash out your pension, whether you're flexibly retiring or full-time retiring, it's called what's called a crystallization event. Bit of techie language there, but in other words, you're cashing out a chunk of your pension. And when you cash out, as Tim was saying, this is your opportunity to potentially leverage your local government pension scheme and take your shared cost AVC potentially all back as tax-free cash in one go. Now, what tends to happen when you flexibly retire is that you're often taking a big chunk. Some cases you're taking it all, some people are taking lesser amounts of their local government, but in most cases it's a pretty significant step down. And if you don't take your shared cost AVC at that point in time, because you don't have to, you could leave it in the long grass until you fully retire, but you're missing out on the opportunity to potentially take it all as tax-free cash, because as Tim was saying, remember, if you take it at the same time as your main scheme and the AVC pot fits within 25% of the capital value of your local government pension scheme, you can take it all back as tax-free cash. So if you take a big chunk out, you've only left little or none left of your old LGPS, if I can call it that. So what then happens if you hadn't taken your shared cost AVC, you said, oh no, I'll wait until further down the track, you are then only leveraging a much smaller pension when you finally do retire. So the ability to take your shared cost AVC all back as tax-free cash is inevitably going to be reduced if you do it further down the line. So in other words, think very carefully. It's normally when you flexibly retire, you're taking the biggest chunk out of LGPS, and that's the biggest opportunity to take it all back as cash. So I hope that makes sense. Then we had a couple of questions from Jane, and Jane's first question was, if my LGPS pension is £15,000 per annum, will I pay tax on that after retirement? So, when we retire, whenever that is, obviously income tax, we pay it on a slice system in the UK as to what our total income is in our retirement, and that includes all of our pensions, etc. Now, remember, most of us will have what's called a personal allowance, which we are allowed to earn a certain amount of income before we start paying income tax. Have a look on your payslip. The standard one is £12,570. So if you look on your payslip, it says 1257L. That means you can earn £12,570 effectively at 0% income tax. If your income is over that, then you're going to start to pay basic rate tax, and then further down the track, you're then going to go into 40% tax. The vast majority of us in our retirement will be basic rate taxpayers. Why? Because you'll have your LGPS pension. So if in Jane's case it was £15,000 a year, then clearly that's over the personal allowance already, and that's before then you add in your state pension once you get to your state pension age. But of course you only pay it on the proportion over your personal allowance. So the reality is you're probably going to be a taxpayer, probably basic rate in your retirement, but only to the extent that it goes over your personal allowance. And then Jane's second question was, can the whole AVC be taken at once? Yes, and the vast majority of cases, what you'll do is take it at the same time as your main scheme and take it all back as tax-free cash. But as Tim will go on to show, there are other ways of doing it as well and taking bite-sized chunks of it. But in most cases, you take it all up front as a tax-free lump sum. And we just had one other question come in, Tim, just before I hand back to you. and that was one from Steve. If I flexibly retire, can I take my tax-free lump sum and start a new AVC on the new pension? Absolutely right, Steve. Yes. But the point is, if you are rejoining LGPS as a new member, of course now you're going to be part-time. You're going to be very likely well, you're not going to have a stronger LGPS membership second time round, are you? So when you do the 25%, if you're looking to take your new shared cost AVC back as tax-free cash, it's going to be quite a limited amount you'll be able to take out as tax-free cash second time round. Now it could be that you don't really want to take it as tax-free cash, you just want to build up a pot to boost income and things like that, then it doesn't really matter. But if you're focusing on taking it all as tax-free cash after you flexibly retire, you're not going to build up second time round as strong an LGPS membership, so your overall 25% tax-free cash is going to be smaller.
Yeah, but obviously, there's a couple of questions on flexible retirement. The big opportunity that you have for tax-free cash is when you flexibly retire. But yes, Steve and others, you can build up a new AVC, when you have flexibly retired.
Absolutely. Right, those are all the questions at the moment. So some great questions to kick off with. Back to you, Tim.
Okay, thank you. Okay, so we'll come on just to clarify how it actually works. It is, of course, a benefit of employment. It has to be paid from your salary. It goes into that AVC, and as I've mentioned, it is flexible. I'll cover this in a second. You can increase and decrease AVCs as you choose. There's a minimum contribution of £2. The reason why we say it's £2 is that's a pound of your money, of course, and a pound of your employer's. So arguably, AVCs are for everybody. Everyone on this call today can afford to put something into their AVC for their retirement. The money that you do put in then is invested by your AVC provider. The AVC provider might be Prudential, Legal & General, or Standard Life. That's chosen by your pension fund. The good news for you is, of course, that you have control on how those companies invest your money. You can take as little or as much risk as you want. You can change it whenever you please. And again, I'll talk about investments a little bit more in a minute or two. You then, of course, we covered it as we were answering those questions. You have flexibility as to what you can do with it on the way out. Yes, in answer to one of the questions, you can take it all back tax-free within the limits. But of course, you could also add to your pension. And I'll clarify those as we go. But again, remember, pension is taxable, whereas the lump sum is tax-free. Okay, now flexibility I've just touched on. They are affordable for everybody, no matter whether you've just started in local government and you've got a long time to go, or indeed if you're quite close to retirement. It is never too late to pay an AVC. Let me just stress that. But as I've also said, you can increase and decrease at any time. It's up to you. My counsel would be, and having done this as long as I have, start as early as you can. Do something. The most important contribution is the first one, because not only is that when you see the tax relief and the national insurance relief, but that's also the first time the monies are invested, and therefore has the longest potential to grow. It is very common for us, Jonathan. I've seen it a long time, and happens quite often that people, when they get quite close to retirement, maybe the mortgages are paid off, maybe you're in your final couple of years or even final couple of months, actually, that's when people pay quite large contributions into AVCs to take advantage of those tax benefits, and then potentially get it all back tax-free quite soon. But more on that later. Now we're going to look at the monies and how they're invested by those different investment companies. I should stress the funds are all chosen by your specific pension funds. Before we talk about how the monies are actually invested, I do want to confirm to you all that the only charge you will pay with AVCs is for the investment of the fund. There's no charges from AVCwise or anybody else to set it up. The only charge you pay is for the investment to Standard Life or Legal & General or Pru. Generally speaking, those companies will charge you somewhere between, I'd argue, probably about 0.5% up to about 1%. You can mix and match the funds. Okay, now I do know, having worked for Prudential for a long time, that they certainly will allow you up to 10 different funds. I don't think the other providers are going to be very different, but you do have the flexibility to change whenever you like. So you might be a long way away from retirement and might think, well, I'll take a bit of a risk with this. I'll put it in stocks and shares. I'll go to the top end of that ladder. But again, as you near retirement, you might want to lessen the risk, so you can switch between and have different ones if you so wish. As you get close to retirement, or maybe you're quite risk averse, you might just want to be down at the bottom end of that ladder in something similar to investing in cash. Okay, now the reason why it says minimal risk, of course, is that all funds have risk, even a cash fund. There is a risk of inflation eroding the value of your money. And actually, in reality, certainly with Prudential's cash fund, the charge outweighs the interest rate at the minute. So in real terms, it's coming down a little. But nonetheless, lots of different ways of investing money, and we'll point you towards where you can get information on these funds. If you're minimal risk, it might be that cash fund. If you are low to medium risk, you're starting to step up into multi-asset funds. Medium risk will incorporate government bonds, which are loans to the government. They will include corporate bonds, which are loans to companies. And indeed, property funds would be deemed to be medium risk. And as you step up into the orange and red areas on the graph that you're looking at there, you're talking about stocks and shares or equity-based funds. Medium to high tends to be equities, global equities, so stocks and shares around the world, whereas high-risk funds are in specific geographical locations, such as UK equities. In addition to all of that, you may have a default fund. So if you're not comfortable making a decision, you don't necessarily have to. Many pension funds, now we're represented on today's webinar by lots of different people, all areas of the country. Your pension fund may have set up a default option, so you don't actually have to pick something, but we'll direct you to how you can find that out later on. In addition to that, you might have lifestyle options within the scheme, and a lifestyle option effectively starts you in a medium to high or higher risk fund, but starts to automatically switch you into lower and minimal risk funds as you near retirement. So you don't have to switch it yourself in that circumstance. So there's something in there that will suit everybody. What I will say before I leave this slide, of course, you'll have heard it before. Past performance, although we'll show you where to get the past performance, it's not a guide to the future, and you may get back less than what you've paid in. However, I do not want you to concern yourselves with investments. Don't be put off by this, because remember, the reason you will do AVCs at some point of your lives is because of the tax benefits. The fund is growing, remember, by 46.8% before it's even reached Prudential or Legal and General. So again, my counsel is don't get put off by that. Now, we look at the reality that is Sarah again and her early retirement. This should help answer some of the questions from earlier. We said earlier that Sarah was going to go at 64, but she understood that her pension was going to be significantly reduced by £4,000. What Sarah's going to look to do then is pay into this AVC pot. She will save tax, she'll save on the national insurance, and when she gets to 64, she can take the whole AVC pot back as a tax-free lump sum, within her limits, of course. But Sarah now has a tax-free lump sum at the age of 64 to help bridge the gap between retiring early and when she gets her state pension at 67. She has a tax-free lump sum that effectively she can do whatever she wants with, and hopefully she's in good health to go and do those things. And hopefully, as things relax, she might actually be able to go on holiday again. She might want to replace the car, spend time with the family, but ultimately that pot gives Sarah more control. Now, that's one of the things that you can do then. I've just demonstrated that if she takes the AVC at the same time, she can get it as a tax-free lump sum. Okay, and remember that is unique to you in local government, but it's not the only option. I have alluded to these earlier. You can, of course, buy a pension from a pension company. It's known as purchasing an annuity, or you can buy more scheme income from LGPS. That's from your respective pension funds, or indeed you could, of course, do a mixture of any of those. Remember that income is taxable, to the question we had earlier, but the tax-free lump sum is, as the name suggests, it's tax-free. Okay, now before I leave this slide, I will draw your eyes to the bottom left there. Pension-wise, no relation to us at AVC-wise. It is a government-led body where you can get guidance on your options. It's an impartial service. It's available to any of you from 50 onwards. And that's primarily to discuss how you can access pension pots, such as AVCs. It's not really designed for your local government pension scheme, I should stress. Okay, now, different pensions then. Under pension freedom rules in 2015, you have a lot more freedom with what you can do with pensions. Okay, from 55, each of you, whether you've taken your main scheme benefits or not, could transfer out your AVC. Okay, and you can transfer it out and do a number of different things with it. You could choose to take a flexible retirement income. It's often referred to as income drawdown. And this is where you can immediately access 25% of the pot as a tax-free lump sum, and the remainder would be subject to tax as and when you draw down on it. Or you could take it as a series of lump sums. And I'm going to talk you through an example with Sarah on the next slide. But effectively, you could take a series of lump sums out of your AVC, and it'll be the tax treatment will be slightly different. Both of those options, however, could be deemed to be bridging the gap, so that you can get out early without having to access any of your main scheme pension. Okay, so to bring that to life for you, let's remember Sarah. So we're going to assume on this slide that Sarah gets to 64, but she doesn't take her main scheme. She doesn't take the LGPS because she knows about the reductions. Okay, she's going to effectively live on the AVC. Now, the mechanics of this is that she has to effectively divorce it from her local government pension scheme. Should be transferring the AVC to another pension pot, such as a personal pension, as an example. But just go with me here. Sarah has a pot of £48,000. Now, you might think to yourself, well, I'm never going to have £48,000. As an example, if Sarah was saving the £250 that we looked at on the pay slip, if she was doing that for about a 13-year period, it wouldn't be too far off a £48,000 pot. So it is achievable. £48,000, then she gets to 64 and she stops work. Effectively, what Sarah is going to do, in very simple terms, is just divide this fund in 3. And that might be why we've chosen 48,000, because I can do the maths. So divide that by 3, you get £16,000. 25% of it is tax-free, because of course it's a pension. So the light blue segment there that you can see, that's tax-free. A quarter of 16,000, again, I can do the maths, that's 4,000. And the remaining 12,000 is added to the income and taxed accordingly. So similar to the question Jonathan answered earlier on, pension is taxable in retirement, but of course, remember, you've got your personal allowance. In Sarah's case, she doesn't have any other income, so her 12,000 that is left over is under the personal allowance. So effectively, she won't pay any tax on this money at all. Right, and she will have to, pick up the phone to HMRC, but to do so. But in theory, that £16,000 was tax-free. She repeats that step, at 65, and the same again at 66. She hasn't paid any tax on that £48,000 pot that was previously an AVC, and all that it has done is allow her to go a few years early. The bigger pot you have, of course, the earlier you can go. All right, at 67 then, of course, Sarah's local government pension kicks in without the same reductions. She did, of course, have 3 less 49ths. I'm not pretending to hide that fact. And of course, at 67, she gets her state pension. What the AVC has done in this case, as I say, is allow her to go early. Now, we've talked a lot about lump sums, and in reality, the majority of people in local authority will take their AVC at the same time as their pension, and you can get it all back tax-free. How it works for all of you is that to work out the size of your pot, you take your main scheme pension, so in Sarah's case 10 grand, you multiply that by 20, you add on any lump sum that you had for your years in the 80th scheme, and then you would add on any AVCs. 25% of that total pot can be taken tax-free. So in Sarah's case, as I indicated earlier, she could have had 71 grand in her AVC and still got it back tax-free. The example that we've just looked at, of course, is that Sarah had a pot of 48 grand. So that 48 grand, it's well within her limit. And therefore, as long as she takes it at the same time as the main scheme, she can get it back tax-free. Different options. You're only going to have those options, remember, if you take out the AVC before retirement. In summary, and we will go back to Jonathan for questions in a minute or two, the LGPS is the only public sector scheme that allows you to do this, to take the AVC as a tax-free lump sum. Employers have to choose to set it up on a shared cost basis, which is what all your employers have done for you, so that's fantastic news. It allows you to save not only on tax, but also national insurance, and take it back tax-free on the way out, of course. If any of you can think of a better way of saving money for your retirement, I'd certainly like to hear your thoughts. Okay, now, before we look at the questions, then I'm going to show you what you can do if you want to apply, having heard all of that. All journeys start with the AVC website, which you will be directed to very shortly. If you want to take out an application, make an application. I'm happy to pick a fund. I'm happy with the amount that I want to pay in. Well, in truth, you're ready to go. Go to the website, enter your details, usual kind of details, name, date of birth, national insurance number, all those kind of things. Might help to have a pay slip. And of course, what I would say is when you dig out the pay slip, look at the amount of tax and national insurance you've already paid. This year. Once you've set the application up, your employer will verify your application, make sure you're not paying too much. They will send off that to your stated provider, and you'll be set up, and your participation in the scheme will start from the next available payroll, which for everybody is probably August, might be into September. Okay, now, in addition to all of that, if you don't know your fund and you don't know how much you want to pay in, maybe your circumstances are a little bit more complicated and you want to talk to somebody, you do have the opportunity of a one-to-one. Okay, might be with myself or one of our colleagues. 20 minutes, Microsoft Teams, one-to-one. Okay, now I have to stress, our time is as valuable as yours. If you want to do an AVC and you want to think about doing it next year, well then talk to us next year. Okay, but if you're ready to go right now, book a one-to-one. What we would ask you to do to prepare for that meeting is look out a local government pension scheme statement or maybe a projection to your retirement age, your desired retirement age. If you've already got an AVC, don't think anybody on the call should have, but if you do, have a valuation with you. Look out the pay slip, as I just mentioned, and of course consider how much you want to pay in. Jonathan or I or nobody else at AVC Wise can do that bit for you. What we can do, however, is calculate that maximum tax-free cash. Sarah could have had 71 grand, remember. We can also calculate the max that you can pay in. We can calculate how much tax and national insurance you save at your chosen amount. And ultimately, we'll tell you how you can take action. Okay. Again, as you can see at the bottom of the slide, no financial advice. Okay, nearly there, folks. Some important considerations and conditions. Remember, of course, you have to be a member of local government pension scheme to pay into AVCs, but you won't damage the main scheme by paying in. You can't pay so much in that you would fall below the national minimum living wage requirements, nor, as I said earlier, can you pay so much in that you would go below the lower earnings limit. That, remember, is the limit where you could damage your state pension, which is £6,240. A few allowances to take note of. Annual allowance is the amount that you can save each year into pensions and receive tax relief. That's currently £40,000. And don't worry, that's not just 40,000 into AVCs. It's all of your pensions, including the growth in your local government pension scheme. Money purchase annual allowance, this could be triggered, and I guess I'm talking to the over 55s here. Money purchase annual allowance could be triggered if you've previously drawn on another pension, such as a personal pension, and that limit is as low as £4,000 per year. And lifetime allowance, this is the overall limit on how much you can build up in a pension pot before incurring a tax charge. It is currently £1,073,100. So I don't know that too many of you, or indeed Jonathan or I, will need to worry about those allowances. You can change the contribution. We said that earlier. Obviously, if you reduce the amount, it'll have an impact on what you can get back. And of course, if you opt out or indeed leave employment, your AVC would have to stop. Further resources before we get to questions then. First port of call might be as simple as digging out the pension statement and looking at what you're going to get when you want to retire. You have the local government pension scheme website for further information. There's modelers and calculators on there. You might want to visit the AVC Wise Knowledge Hub. There's loads of information on there. You'll find calculators. You know, if I pay in X, what will I get back, or what could I get back? There's explainer videos on there. There's an FAQ section which details all of the questions that Jonathan and I've ever been asked. And indeed, there are also details on the upcoming webinars. You have sat through today the LGPS and shared cost AVCs, but there are other bite-sized versions just to maximize your knowledge there on the shared cost AVCs and local government. Okay, final slide. Then questions. Final slide today just reiterates where you can get information on the Knowledge Hub, the FAQs, the member website. You can pick up a telephone to speak to us. We have live chat on the website. And for those of you who do want a one-to-one, you've got the email there, support@AVC Wise. Okay, so I'm going to draw breath again. Jonathan, over to you for final questions.
Okay, thanks, Tim. Yes, we've had 4 questions in. Firstly, from Katie, what happens to your AVC pot if you leave local government and the LGPS before retirement? Well, what will happen then, Katie, is you can't carry on paying into your shared cost AVC because it's done through your payroll. You have to be an active member of LGPS to pay into it. Safe to say, obviously, then you've put that money into that provider. That money is still investment. It's still a live investment. So, what will happen in most cases is you'll end up with what's called a deferred main local government pension scheme benefit, and you'll have this shared cost AVC pot. Of course, your options are, if you move to another employer, potentially you could transfer everything lock, stock and barrel over to that new employer. If you're going into LGPS somewhere else, or potentially another public sector scheme, if you go and work in the private sector, it's very unlikely you're going to have this type of pension arrangement, i.e. what is known as what we call a defined benefit scheme. So you're probably, depending upon financial advice, probably going to leave it where it is. And now, if it's left where it is, certainly from a shared cost AVC perspective, you can still make changes as to where it's invested. So, at the end of the day, it's your pot of money. What you won't be able to do is to pump any fresh money in unless you join an LGPS employer which operates shared cost AVCs. Sharon's then asked, do you only get back what you paid in, or do you gain interest? Well, when Tim was talking about all the different investments, Sharon, you will decide which waters you feel comfortable fishing in. with where your money is invested. And of course, as we've said, investments can go up, they can go down. You could get back less than what you put in, but always remember you've got such a huge buffer from the tax man, though the provider, whoever that is going to have to do an appalling job with your money before you're personally out of pocket. Now, the whole point is that when you go into funds, whichever funds they are, you're buying units in funds and they're invested. And the hope and ambition is, of course, that you can get some growth on that as well. So you don't get interest as such, because you're buying units in funds, and the way it works is that any returns are reinvested back into your pot. So hopefully you get what's called a compounding effect over time, growth on growth, and whatever that journey is depends what type of investment you're in. And as Tim was mentioning earlier, if you go into something like the stock market, you've got the biggest potential for gain, but also the biggest potential for loss because of the relative ups and downs. But as I said, you can diversify your money, and if you don't even like any of that stuff, you can even put it as low risk as a cash fund.
Yeah, and I think just sorry, Jonathan, to interrupt there. I think you and I have talked about this a lot. What the pandemic has shown us over the last few years was that obviously when that struck, the stock market certainly collapsed is probably the word I'm going to use. But then it has recovered in the last 12 months, hasn't it? And I suppose what everybody on the call doesn't want to happen is that the next big crash coincides with your retirement. Okay, so for those reasons, if you're getting quite close to retirement, you probably don't want to take the same level of risk as someone who's a long way out. But ultimately, look, the investors of your money would have to do such a bad job for you to get back less. Sharon, I think it was asked the question, because you've had that 46% straight away.
Yeah, absolutely. I mean, for example, if you look back over a longer period of time, if you had been invested in the stock markets over the last 10 years, you'd have doubled your money just through the investment growth over that period. Now, does that mean it's going to double again in the next decade? Probably not, given all the uncertainties and headwinds we now face. But my point is that being invested is so important, and the sooner you do that, the better. Okay. Nikki's then asked, can you adjust the payments made into the AVC, or does it have to be the same every month? No, not at all, Nikki. You open your AVC Wise account with whatever you feel comfortable with, and then you've got that ability, once you're on board, to log on to your AVC Wise account and click the amend button, and you can increase and decrease. So obviously it will take a bit of time for that to be approved by your payroll provider. So it might not definitely happen the next month, but certainly within one pay cycle, you can adjust accordingly. And then Jacqueline's asked, if you get made redundant, would any redundancy pay be calculated on your income prior to the AVC contribution or after? Great question, Jacqueline. It's down to the discretion of your particular employer. So what I'd encourage you to do is to go onto the AVC Wise portal, click on the frequently answered questions. Now, for the vast majority of AVC Wise clients, actually, if you were made redundant and you're doing a shared cost AVC, they will still look at your pre-salary sacrifice or your notional salary. So in other words, you won't have damaged your redundancy payout by doing this. Now, I can't say that that's the case for every employer we deal with, because some employers say, well, actually, yes, it will damage it. Now, if you are in one of those few employers where redundancy can be affected by doing shared cost AVCs, well, not that you're perhaps likely to get a true heads up on it, but before that announcement was made, or you thought something was in the air, you could always reduce down or stop your shared cost AVCs entirely. So even if your discretion was that it would be affected by it, you can make sure that you're not in it prior to any potential redundancy. But as I said, the vast majority of you, and I said, Jacqueline, I'm not sure off the top of my head who your employer is, but just log on to the AVC Wise portal, and there's a frequently answered questions section in there, and there'll be the policy term for your employer as to the redundancy policy. That's it, Tim. Back to you.
Okay, brilliant. Well, look, I think we're maybe a couple of minutes over, just based on those questions. So thank you for all your questions. I hope it was of use. But look, I suppose if I can sum up, I just want to reiterate the fact that everybody on this call today is in a great pension scheme. maybe not you and I, Jonathan, actually, but everyone else. But I suppose the question you have to ask, is it going to be enough? Particularly if you're like Sarah and want to go early. We've shown you, hopefully, how tax efficient and flexible the AVCs are, and how they can help you retire early or retire with more money. My hope for today is that you take something out of today, first of all, and you take out the pay slip and you take out the pension statement, and hopefully you take some action. Thanks for attending, and good morning.